Hello class, this is Dr. Fenton. In this video, I'd like to show you how to work exercise 1310, which is also question number 6 in your Module 7 homework. So your Module 7 homework has the exact same wording as exercise 1310 in the back of the chapter, but the numbers are different. But everything else is the same, just the numbers are different. This is a net present value analysis problem. So let's see what it's requiring us to do. Number 1, compute the net present value that Kathy earned on her investment in multi-company stock. Let's see what the information is. So Kathy purchased some stock. If you read it, she purchased it 3 years ago and paid $23,000 for 500 shares. Each year, for 3 years, she received a $460 cash dividend on the stock, and she received that, as I said, at the end of each year for 3 years. At the end of the 3-year period, she sold the stock and received $30,000 cash. So she likes to earn at least 13% on all her investments, and she's not sure whether this stock investment provided a 13% return. So we need to see if it did. The first step is, as it says, let's calculate the net present value. Now to do this, we will need to know the future cash flows, which will be the cash dividend each year for 3 years of $460, and then the stock selling price at the end of 3 years at $30,000. We also need the 13% rate of return she would like to earn on her investment. Alright, so what I did to help calculate this is set up an Excel file. I went ahead and typed all this information in to save some time. So what we're going to do is find the present value of the future cash flows. And so we need to find the present value of the annual cash dividends received for 3 years. And we need to find the present value of the sale price of the stock at the end of 3 years. So going back to the problem, again, she received $460 a year in cash dividends for each year, and she received $30,000 when she sold the stock. So let's plug those numbers in. Dollar amount, $460, and then she sold the stock for $30,000 at the end of 3 years. We need to find the present value. But first, what is present value? I'll type this in. The present value is the value of the future cash flows in today's money value. And just as a general rule, $1 in the future is worth less than $1 today. For this problem, today is the day the stock was purchased. So the stock was purchased, let's go back here, it was purchased for $23,000. Here it is, $23,000. And I'm going to drop this in, our original purchase price, $23,000. So this is the information given to us in the problem. So to find the present value of an annual cash inflow, we will go to, I just happen to know it's in table 13B2. Let's click here, and so this pops up. This is the present value of an annuity of $1 in arrears. Arrears means you received it at the end of the year, which the problem told us that she did. An annuity is an equal dollar amount every period or every year. So what we're going to do is look up the percent we're working with, 13%, and go down to 3 periods, 3 years. So 2.361. So again, 13% column, the 3 period mark, 3 years, 2.361. Let's type that in, 2.361, enter. Now we need to find the factor for one lump sum in the future. Remember that $30,000 is not $30,000 each year. It's $30,000 at the end of the 3-year period. So going back to the problem, we need to, let me get back to the problem, use Exhibit 13B1. Click here. You'll see it's worded differently up here. It's the present value of $1. It's not the present value of an annuity of $1. We're looking at one lump sum in the future. What is the factor we need to find the present value today? Use the same percent, 13%, same number of periods, 3 periods, and the factor here is 0.693. So 0.693, let's type it in. 0.693. Now let's multiply. So this is going to be equal to this times this, hit enter. So this is saying that those 3 future $460 payments is worth in today's money only a total of $1,086. Next, let's find what this is worth, equal to $30,000 times this factor, hit enter. So $30,000 3 years in the future at a discount rate of 13% is worth only $20,790 in today's money. So let's find the total value of all these future cash flows, total present value. Let's add these, so let's sum it, hit equal. So the investment has thrown off cash flows in today's money, future cash flows in today's money, a value of $21,876. $21,876. Now we're going to subtract from this the present value of the initial investment. Well, the initial investment, when she paid $23,000, and we're using today as the day she paid the $23,000, the factor is just 1. Okay, so this is equal to, you can just do it in your head really, but it's equal to 23,000 times the factor of 1, 23,000. Okay, so 23,000 paid today is worth 23,000. 23,000 you might receive today is worth 23,000. But the amounts you receive in the future are worth less than the amounts you received in the future. Converting those to today's value, you can see the amounts are less. And so what we need to do to find the net present value is now subtract from the future cash flows today's investment. So this is equal to, put equal, the future cash flow in today's money minus what we paid today. And you can see the net present value is a negative $1,124. And going back to the problem, right here, you can see that's the answer, a negative $1,124. So this investment, if you're trying to earn 13%, and the net present value is a negative number, in this case negative $1,124, the answer to 2, did Malta Company, did the stock provide a 13% return? The answer is no. Again, the answer is no, because the net present value is negative. If the net present value would have been positive, the answer would have been yes. So that's how to work this, this problem. Going back to the worksheet, you need to find the present value of the annual cash flows. Make sure you get the number of periods correct, 3 years, 3 periods. This is the same amount each year. That's the factor that we looked up in Table 2, the 13% column, and the 3-year row. Here, the $30,000 is one lump sum in the future. Go to the other table, the B1 table, and pick up that factor. Multiply across, then add, and this is the total present value of the investment. Subtract the original cost of the investment, and this is the net present value. In this case, it's negative because this investment did not earn 13%. I hope that helps, so good luck.